The semiconductor revolution is usually told through the lens of computing power faster processors, smaller transistors, and the rise of AI. But there is a parallel revolution happening in power, how we deliver electricity to these hungry chips. For decades, silicon was the king. But now, new materials like gallium nitride, GaN, and silicon carbide, SiC, are challenging the throne. And one of the purest bets on this transition has been Navitas Semiconductor. Today, we are doing a deep dive into Navitas, ticker symbol NVTS. We have analyzed their financial filings from 2020 all the way through the latest Q3 2025 report. This is a story of extreme volatility. It's a story of a company that rode the hype cycle to the top, crashed into a wall of market reality, and is now attempting a painful yet potentially lucrative turnaround under new leadership. Let us rewind to the context of 2021 and 2022. Navitas came public with a clear mission: to replace legacy silicon power chips with gallium nitride. Their GaN-fast power ICs promised to charge phones 3 times faster and make chargers half the size. The market loved it. They secured wins with major mobile OEMs like Xiaomi, OPPO, and Vivo. Revenue was growing and the narrative was perfect. But as we moved into 2023 and 2024, the cracks began to show. The company was heavily dependent on the consumer electronics market, specifically in China. When the Chinese economy slowed down and smartphone demand cooled, Navitas felt the pain immediately. Now let us look at the hard data from the latest reports to see just how deep this crisis went. We are looking at the 10Q report for the third quarter of 2025, ending September 30th, 2025. The numbers are stark. Revenue for the quarter was $10.1 million. Compare that to the same quarter in 2024, which was $21.7 million. That is a collapse of 53%. If we look at the first 9 months of 2025 combined, revenue stands at $38.6 million, down 41% from $65.3 million in the previous year. The management was very clear about the cause. The decline in sales was mainly due to the decline in sales to the mobile and consumer markets in the China region. This revenue collapse triggered a massive house cleaning in 2025. First, there was a change at the top. The reports confirmed the separation of the former CEO, Gene Sheridan. As of late 2025, the company is being led by Chris Alexander. A CEO change during a downturn is often a signal that the board demanded a new strategy. Second, they slashed costs. R&D expenses dropped by 26%, and selling, general, and administrative expenses plunged by 65% in Q3 2025 compared to the prior year. The company executed a reduction in force, layoffs, to stop the bleeding. But here is where the story gets interesting for a contrarian investor. Despite the revenue drop, the company's balance sheet actually improved in cash terms. How? They executed at-the-market offerings, essentially selling stock to raise cash. In the first 9 months of 2025, they raised nearly $100 million. As of September 30th, 2025, Navitas holds $150.5 million in cash and cash equivalents. This is a massive war chest for a company with a quarterly burn rate that is shrinking. It buys them time. It removes the immediate bankruptcy risk. So, what is the new strategy? They are pivoting away from just being a China mobile phone chip company. The 2025 filings emphasize their expansion into AI data centers and electric vehicles. AI data centers are power-hungry beasts. They need efficient power conversion to prevent overheating. Navitas claims their GaN technology can save massive amounts of energy in these server farms. In the EV space, their GeneSiC silicon carbide technology is targeting onboard chargers and roadside charging stations. These are markets with longer design cycles but much stickier revenue than cheap phone chargers. However, we must be realistic about the risks. The gross margin in Q3 2025 was around 37%, down from nearly 40% a year ago. they are still losing money, posting a net loss of $19.2 million for the quarter. While this loss is stabilizing, they are not yet profitable, and the stock has been volatile. The 10Q notes a significant change in the fair value of earnout liabilities because the stock price rebounded from lows of 46 cents in 2024 to over $3 in September 2025. This suggests the market is already starting to price in a recovery. So, what is the verdict? Navitas Semiconductor is a classic turnaround play. The bust phase of 2023 to 2024 is over. The revenue has reset to a lower base. The old CEO is gone. The costs have been cut. They have a $150 million cash cushion. The thesis now depends entirely on execution. Can Chris Alexander and the new team take their world-class GaN and SiC technology and successfully sell it to US and European data centers and automakers? If they can diversify away from China Mobile, this company could be a multi-bagger from these levels. But if the revenue stays stuck at $10 million a quarter, that cash pile will eventually run out. For investors, this is not a sleep well at night stock. It is a high-risk, high-reward bet on the future of power electronics. The technology is real. The question is, can the business catch up to the science?